In this tutorial, I'll show you how to set up a vertical spread trade for a put or a call. I'm using the thinkorswim platform from TD Ameritrade. This is similar to most of the option trading platforms out there. When you bring up your platform, you'll go into the section, which is probably on the toolbar, where you'll install your trade and execute it. The instrument that we trade is the SPX, which is the S&P 500 index. The type of trade is going to be a vertical spread. And now we're going to look at our strike prices. Strike prices here in the middle. You see two sides of the strike prices, two prices under the strike, as it is a spread that we are trading today. So we'll look at a spread. Let's say hypothetically we're looking at 205, 210. We'll go to the put side. We'll click on the trade, click on that strike price, and below will be your trade setup. The first thing you want to be sure of is that you're on the sell side. This is very important. We are only sellers. We are never buyers. If your trade looks like this, and you have debit over here, you know that you made a mistake. You always want to be a seller, and the way you tell that you're a seller is that the higher price is always on the sell side of a put, and the buy side is always the lower price. We'll change the quantity to 20 so that it looks like how we set them up at the website. Symbol is the SPX. Make sure you have the right expiration week. We're November 2nd, 2014. November 2 actually is the second week of November. Strike is 210, 205. They're puts. The credit or the premium is 20 cents. This is the amount that will be deposited into your account, depending on the number of lots that you trade, immediately when you execute the trade. This is the order type, and this is extremely important again. You never ever want to place a market order. Market order, you'll always give up some profit to the other side, to the traders, and you always place a limit order. You can always change the limit order, you can cancel it, you can do whatever you want to do, but if your trade is filled at 20 cents, you will get 20 cents or better if the market gets better, and not lose any profit on that trade unnecessarily. Duration is 1 day and it's best price. Now we'll head towards execution of the trade. So we have confirm and send down here. In the confirm window, we'll have a description of the trade. The order description is sell 20 vertical SPX 100 weeklies, November 2, 2014, 210, 205 put at 20 cents limit to open. The break-even price here is 2009.80. That's the approximate break-even price of this trade. I say approximate because this is going to change over a period of time while you're in the trade. But this is the approximate break-even price. The maximum profit that will be deposited in your account when you execute this trade will be $400. The maximum loss is $9,600, not including possible dividend risk. These are index options and there is no dividend, so you can disregard that. The cost of the trade, including the commissions, is $400 minus $39.99 for a net credit of $360.01. The buying power effect is $9,600. This is the amount of margin that the broker requires to execute this trade. The broker will then hold this amount in your account for the duration of the trade until it expires on Friday or you exit prior to Friday. The resulting buying power for stocks and options is strictly related to how much equity you have in your account and what other types of trades you're taking. So now we're going to execute the trade. We're going to send it. The market is closed at the moment, so it will sit in the order queue until the morning. So we have one working order there, which will execute in the morning at that price if the market is at that price. If the market was open at the moment, chances are you would be filled immediately, and then you would see under your filled orders, you would see it in this area right here. You can monitor your trades every day by looking at your account, seeing where it's going. The goal here, of course, is to have the option expire worthless. So going back again to the trade, we'll now do a call, which is exactly the same setup. Only on the other side of the market, we're going to be way above the current price. So let's do a call here around 50.55. Now when I hit the call side, notice that it came up as a debit. You immediately want to change that because we are selling. Our quantity again will be 20. It's the same expiration. Now the sell side is lower than the buy side. So the price of the sell is now lower on the for a call than the buy side. So it's just the inversion of the put trade. The current credit right now is $1.10. That's the premium that'll be deposited into your account. It's a limit order for the day, best price. Let's confirm here. Reviewing the order, we're selling 20 vertical SPX 100 weeklies, November 2, 2014, 2050, 2055, call at $1.10 limit to open. Break-even stock price here, or index price in this case, is 2051.10. Again, that's a gross approximation of the break-even price. The maximum profit you will make on this trade is $2,200. The maximum loss would be $7,800. The cost of the trade would be $22 minus the commission for a net of $21.60.01. The amount that the broker will hold in your account to cover this trade is $7,800. So here we'll go ahead and we'll send. And once again, it's going to sit in the working trade area until the morning. If the market was open, chances are that we would be filled immediately on this trade, and we'd be set up. In the next tutorial, I'll explain how the margin is calculated and how you can calculate your ROI, or rate of income percentage, on these trades. As for the setup, it's fairly straightforward. We occasionally do iron condors. We won't be doing them very often in the future, as verticals are have a higher probability in our estimation, but I will make a tutorial on iron condors just so that you know how it's set up.